Well, good afternoon, everyone. I'm very excited for another episode of the Industrial Real Estate Show, and pleased to be joined by a fellow Canadian and industrial real estate investor. Stephen, thanks so much for joining me on the show.
Great. Thanks, Chad. Happy to be here.
So you have a background in engineering, and then we actually both did the Sauder School of Business, the real estate division. What engineering program did you do when you were in school?
So my background's in systems engineering. So I have a degree in systems engineering, but for Sauder, I took the diploma in urban land economics.
Yeah, I did that same program. It was a great program, actually. I recommend it to a lot of people.
And I think, in engineering specifically, even though I'm a systems engineer, I worked a lot in commercial real estate and construction projects. And so I think that combination of the engineering background with the application of the sort of the real estate and the finance and the economics was a really, really good combination for me.
When did you start investing?
I started about 20 years ago investing. So I primarily focus on industrial real estate now, but I've done everything from your simple single family home to, duplex conversions to multi-unit residential projects, some Airbnb stuff along the way. And then obviously now the last several years just been focused on, acquiring and redeveloping industrial buildings.
Cool. Well, I mean, that's what I love talking about. So it's a natural spot to jump into it. What got you into industrial? What was that itch that you had to scratch?
Well, so I left the corporate world about 3 years ago, and I was searching I knew I wanted to do something in real estate, and I was searching for something that, was going to support what I wanted to do long-term in terms of, being a full-time investor, running a real estate business. And so I looked across the sort of span of all the asset classes in real estate, and I kept coming back to industrial real estate for a couple of reasons. One, I think the most obvious one is just the simplicity, right? Having had experience on the residential side and dealing with, lots of tenants and, landlord-tenant rules here in Ontario aren't as favorable for the landlords. I kept coming back to the simplicity of commercial real estate and specifically industrial. I like to think these are kind of blue collar buildings, right? Like they're pretty simple. Some of them are a little bit more sophisticated in terms of having, higher end finishes and more office space and a bit more bells and whistles. But, at the core of it, industrial is pretty straightforward. You've got, for the most part, pretty straightforward setup in terms of how you use and manage the space. You've got the ability to work with, business tenants who, understand that the rule of thumb is typically having a triple net lease. And so the way you're managing these buildings is pretty straightforward. And just again, it's the simplicity of these buildings. They're used for everyday sort of essential services by tradespeople, by small businesses, warehousing, distribution, et cetera, et cetera. So the simplicity was one of the main things. We can talk about some of the other things, but I think that was the main one. And then also just the ability to work on bigger scale projects coming from the residential world. Unless you're doing, very large multi-unit projects, you're having to do a lot of smaller residential projects to really have that leverage and keep a sustainable business going. So I really like the sort of the leverage and the scalability of industrial real estate as well.
So most of what you're chasing right now or developing is in that 10 to 50,000 square foot range. Is that right? Still what the target is?
Yeah, so we specialize in Class B industrial real estate in secondary markets here in Ontario. So even though we're based in the Toronto area, we invest in secondary markets outside of the GTA. And so typically, we're looking for buildings 10, 30, 50,000 square feet, some value add component to them. And typically they're older vintage, Class B type stuff. We're not looking, the sort of Class A large scale Amazon warehouses of the world, those are not our market. We'll leave those to the big institutional investors. And so, we're sort of looking at that mid-market niche.
What would be your average tenant size then?
Average tenant size is typically having a unit of about 4,000 or 5,000 square feet.
Okay. And And so when you say secondary market, how do you define that? Is it a population size? Is it proximity to Toronto or a major city? How do you define that?
Yeah, so smaller city, definitely 100,000 population minimum, all the way up to sort of 250, 300,000 in population. And that gets us outside of Toronto, outside of these major cities, Ottawa as well, outside of these cities in Ontario primarily. And we're finding a good niche in these secondary markets because even though they are smaller in size, there is a substantial enough local economy to support the types of tenants that we're trying to attract into our buildings, right?
Interesting. What was the first project that you did, or first industrial investment that you did?
Yeah, so the first investment that we did was acquiring a older industrial building up in Sudbury. So Sudbury is a couple 100,000 population, and it's got a very sort of stable local economy supporting primarily the mining industry up there. And so there's a lot of demand for industrial space, the smaller kind of industrial units. And so the first acquisition was acquiring a 12,000 square foot industrial building, multi-unit building up in Sudbury that was fully occupied, no vacancy, and very favorable sort of lease terms with triple net leases already set up. And, over the course of a few years, we worked to increase those lease rates and basically renew leases and update the leases as going forward in that particular building.
Do you still have that one?
I do. Yeah. It's a very good asset. I think we're going to be holding that long term for sure.
Yeah, it's funny. The first property that I ever bought, smaller than that even, still have it. So it's interesting when you have that first one. It's a special place in your heart just because that's where you kickstarted that industrial journey. So
yeah. And again, it had all of those things that I liked. I mean, it had the simplicity of it. It was primarily warehouse space, but some office mixed in there as well. The tenants were, pretty well set up there. They weren't going anywhere. So it checked a lot of boxes in terms of what we wanted to do to get started.
Were there any red flags that you perhaps could have used those as an excuse to not proceed, but you just powered through it?
Yeah, good question. So as you know as well as I do, completing thorough due diligence is really key to having success in industrial specifically, just because of the nature of a lot of the tenants that we deal with, right? I mean, there's just different things going on within these buildings. So there were some environmental, I wouldn't call them issues, but environmental some information that we had to go through regarding the history of the building and some of the previous uses from 20 and 30 years ago. And I think if you sort of just skimmed through this information quickly, I think at first glance it might have been a red flag. And you said, well, I don't want to do that because of some previous uses. But the more we looked into it and the more I researched and, got the advice and input from, qualified staff. So in this case, it was environmental engineers who looked into the history and found out that there was actually some remediation work done and everything was done properly and things had been signed off. And so we were able to have full documentation that there were actually no issues with the property. But at first glance, it might have seemed that there could have been. So it did push back the timelines of the project a little bit. But in the end, the property was given a clean bill of health, and we were happy with what we had going forward. So it did all work out.
I think that's what a lot of people underestimate about the commercial, specifically the industrial side, is the environmental issues. Because if at first glance if you've only invested in housing or multifamily, you've likely never come across an environmental, let alone one that has areas of concern. And like if they recommend further testing, or if it was a phase 2 and then they actually discovered contamination in there, that can be a pretty daunting process. When you were buying that first property, did you get financing on it?
Yes. Yeah, we did.
So I'm guessing the bank then probably had all their prerequisites. They wanted to see property condition report, an appraisal, and an environmental. What did you put together as a team to ensure that that first one, because that first one's also so important because you're establishing a track record and you don't want to make a mistake on that first one, otherwise it could tarnish your reputation going forward. So how did you go through the process of just getting a team and making sure you were comfortable with that asset?
Yeah, good question. I think a couple of things I had going for me. One, I'm an engineer, so I understand working with other consultants and other engineers and other experts in their particular field. So I think I sort of hit the ground running from that perspective. I was very familiar with reviewing engineering reports, consulting reports, having meetings, talking about findings and things like that. But I think the other thing that definitely helped is, I'd gone through a previous deal before that, which I walked away from. And so, I had a bit of a heads up on some of the things to look forward to or things to watch out for. And so the previous deal was a little bit of a, complete lessons learned checklist to go through on the deal that ultimately ended up being our first one. So I think a combination of those two things, just having a bit of expertise as an engineer to be familiar with dealing with engineering reports, and then also just having the lessons learned from a previous deal that didn't work out.
Yeah, that's a great point. I had this conversation with someone the other day, and I was saying that industrial real estate should actually scare the average investor. Like if someone has just bought houses before and they're like, I should go and buy a warehouse, I think that's actually a terrible idea. So I've found that there's three categories of people that I think work best to become industrial real estate investors. Someone that already works in the field, like yourself, you had a lot of experience with it and understood the process, or it could be a lawyer or a broker, an appraiser, somebody that has a lot of experience in that field already, or a business owner, someone that perhaps owned a warehouse or leased a warehouse for a number of years and they understand it all, or someone that just wants to get really nerdy about it and digest everything that they can and spend a bunch of time learning it and be prepared that it's a learning process and you're going to have to walk away from deals before it. On that one that you did walk away from, did you spend a bunch of money on due diligence as well that you had to essentially leave as a sunk cost?
Yeah, absolutely. I mean, that's you paid for the lessons. I always tell people it's not cheap, but I mean, those lessons, even though I did pay for them initially, have saved me a lot of money down the line. So absolutely, it was a lot of time, a lot of effort, and a good amount of money spent to kind of go through it. But you can't, even though you want to get discouraged by those things, it's just part of the deal. And as well as I do, commercial real estate is not cheap. And so it's just part of it. Sometimes you're going to have those situations where you're spending money. But the best thing you can do is just walk away. And so, you just got to come to terms with that.
Yeah, it can be expensive. Like it can cost $5,000 to $10,000 in due diligence if you have to order all the reports, if you have to get your legal involved, $5,000-$10,000 or more. And some people think, well, that's a crazy amount to just walk away from. But it's better to walk away from $5,000 or $10,000 than to take on a deal that just doesn't work and doesn't make sense, because there'll be way more than $10,000 in losses and aggravation and stress and everything that comes with it.
Yeah. And that scalability that I mentioned before and having that leverage. So that obviously works positively for you, but it can really work negatively for you as well. So, I mean, absolutely. So it's $5,000 or $10,000 to pay for some lessons learned that is going to save you potentially hundreds of thousands or millions later is not a bad deal the way I look at it.
What was it about that first deal that caused you to walk away?
It had environmental issues. And they hadn't been cleaned up. We did get a quote for doing some remediation, and the seller did not want to work with us on that particular deal. Which, I mean, it's understandable, their perspective, but that ultimately is what led to me walking away. It was too much risk because we had just investigated and taken soil samples from one portion of the property. It was rather large. It was about a 3.5 acre property. And I thought, okay, this might just be the tip of the iceberg here. So if we're looking at spending hundreds of thousands to clean up this one part of the site, who knows what's in the rest of it, right? So that was enough for me to just walk away.
Yeah, and I don't blame you at all. That's
Yeah,
that's a huge issue. I've personally never actually gone down the road of remediating a property. I've been involved in
right.
a lot of phase twos where you're doing the testing, and hopefully it always comes back that there's no elevated levels of contamination. But when it does, that's usually a deal killer, just for exactly as you said, the uncertainty of knowing exactly what it's going to cost to remediate that, and how bad is it? Like, how far does it extend beyond even just that one? If you only did one borehole, how much contamination is there? And then you start
Yep.
getting into what happens if contamination led to other properties, and then if the source was rooted to that property, do you have to worry about lawsuits for your site contaminating other sites? Like, it is just, once it gets to that level, I've found that there's not a lot of investors that have the risk tolerance to take it on past that.
Yeah, and that's just what it is, Chad. It's risk tolerance, right? So there are scenarios where, again, you could define it. You could say, okay, look, we found an issue. Here's a way to mitigate it. Here's a way to remediate it in the case of environmental issues. And, we're confident that it can be contained, and we're confident that this will, provide us a level of comfort going forward in the deal. But if there's all these other unknowns and all of these other risks that just keep popping up, at a certain point, yeah, you just have to walk away.
Yeah, there's nothing wrong with walking away. In fact, it's much more prudent to walk away from a bad deal than to try and patch together something that's just too difficult anyways.
Yeah, absolutely.
So with the building, what do you really look for in a building so you're in these secondary markets, something hits your desk? What's a great property for you guys?
Yeah, so we're looking at a couple things. So we review a lot of deals, and it's a point of just looking at these deals and getting better of not spending a great deal of time on every single one that, if it's really not going to pass the test of a few simple metrics. So we're looking at very simple things like price per square foot. We're looking at things like the lease rates if they're readily available. We're just looking at cap rates in the area. Are there a lot of vacancies in the building? So, here in Ontario, what we found in the secondary markets is that ratio in a lot of the secondary markets of what you're able to charge for lease rates versus what you're paying per square foot is much more advantageous than, let's say, a market like Toronto, where the land costs are so high and the price per square foot is just through the roof, right? So even though you are able to charge higher lease rates, it's not as beneficial as if you were out in secondary markets in terms of a value perspective that you're able to generate. So, we mentioned risk before. So some of the things we look at to sort of lower the risk and just fall into our sweet spot are, a solid price per square foot. So, ideally we can get something at or under what the building cost would be. And I know, a lot of people would say, well, hey, how are you finding these deals? And sometimes it's just an opportunistic sort of, way that you're able to work with a broker or know people in the local market. And, you're finding these properties coming up for sale here and there. So we're always looking at price per square foot as a key metric. Obviously, the ability to either walk into a property that's tenanted or look for opportunities that, there's an advantageous lease rate in the area. Maybe there's a vacancy coming up where you can refill it and you can charge a higher rent and then that you can pump up that sort of return on investment in that particular building. We're looking for multi-unit properties. So, we don't want to be dependent on one single tenant. So all of our properties are multi-unit. We're looking to spread that risk. And even though if we do have one vacancy, it's not going to completely derail our cash flow for that particular asset. And I think the other thing, just quickly that we'd be looking for is, value add opportunities, right? So whether it's a lease, whether it's an expansion to the building, whether it's the ability to divvy up the units into more units, and just sort of that flexibility and that opportunity to provide more value in the building.
I love how you described all of that, and I agree completely with that flow of quickly analyzing a deal, and I'm the same way. It's price per square foot is the first thing that I always look at. If you see something that's double the market, I don't need to look at anything beyond that. It's going to be very hard to make that work. And then you start digging into it. What are there any things that would be instant deal breakers for you that you see it on the brochure or the OM and you're just like, nope, that automatically rules it out?
Yeah, I think some of the deal breakers would be probably configuration of the building, and lack of, let's say, outside space. What I find more and more in just dealing with tenants and managing our existing properties is just there's just such a demand for space, right? And it's not only inside, but it's outside. So you need that space for parking, you need that space for truck turning. You need that space for dumpsters and outside storage, and sometimes just sort of these temporary, drop shipments that come in. And so when I see a building that may be attractive and a price per square foot, but the configuration and the layout and the just the general space that's available isn't advantageous, then that's a red flag right away. Now, it's not to say that you couldn't make a deal work at the right price, but that for me is just sort of a red flag right away. Other things would be, just ceiling height. So if you're looking at buildings, now mind you, we have some of our buildings which in certain areas the ceilings are as low as 16 feet. And compared to some of the modern buildings, 30, 40 plus ceiling heights, some people would say, well, why are you investing in those types of assets? And the reason is there's in the Class B space, there's still a lot of demand from these small businesses and tradespeople and different types of industrial tenants for units, even though they may have a lower ceiling height. But if it's an attractive enough price point, there will be demand for those units. So ceiling height, I think if it's extremely low, that would be, let's say less than 16 feet, that would be hard to make that deal work. So I think, the configuration, the size of the space outdoor on the building and the ceiling heights, those are a couple things that I'm just, when I see a building and sort of the layout and the profile of it, that just stand out to me.
Yeah, I agreed with everything you said there. I was talking to a guy the other day, and he had a great one. He said that his flow is that he looks at the site plan first, and if the building's not a box or a rectangle, he's automatically out. He won't look at anything that has an L shape. And I agree with you. I think that there's ways to make those deals work. But that was just an automatic stop for him. If it wasn't a box or a rectangle, he automatically moved on. Didn't look at anything else after that. I found it interesting how different people will go through that process of eliminating deals off the bat.
Yeah, you see a lot of those buildings too, where they're a little bit of a Frankenstein, where it's okay. The original building was from 40 years ago, and then there's like a L-shaped piece on the back that's maybe from 20 years ago, and then they put another little addition, and the ceiling heights are all over the place. And yeah, I mean, sometimes you can make them work, but it just right off the bat, it's a bit of a red flag sometimes.
Yeah, for that guy, it was a deal breaker right off the bat. I just found that so interesting. There's another guy that I had talked to last year that I interviewed, big investor in Chicago. And for him, he said that parking was the main thing that he looked at. Yeah. He said that he's just had too many tenants that complained about parking, or he couldn't fill a space because it didn't have enough parking. For him, that's what he looked at right away. If the building didn't have enough parking for like what he measured loosely as the size of the building and the size of the yard and how much they would have to park, that was a deal breaker for him. So it's always interesting to see how people will do that, back of the envelope analysis on saying, okay, well, if there's this I just don't like, so I'm moving on. So I always find that interesting. When you get sent a property, and let's say it does check all those boxes, so it has ceiling height and has good site coverage, and there is parking and checks price per square foot, everything looks good at face value. How do you go through the process of then either underwriting it to see if it has more potential, or are you touring it next? What's your process of it if you see a property you actually like?
Yeah, good question. So the next, once we've been through that sort of first pass quick analysis, the next thing we would typically do is ask for more supporting information on the property. whether that's copies of the leases or, rent rolls, something like that. Anything else that would be on file that we can just sort of quickly have a look at in advance of actually physically making the time to go out and tour the property. So I just find if good brokers will have that information readily available, and most times you got to sign a confidentiality agreement. But if you can start collecting that information, and then in parallel, what we would be doing is just running a first pass sort of pro forma on that particular building. And there's a lot of assumptions you're going to have to make if the information is not readily available. But, we've now, again, completed that sort of first pass analysis. And then the second sort of phase would be spending a bit more time doing a pro forma, reviewing the documentation on file. And then if it passes that, then we're making plans to go out, tour the property, talk to the brokers more fully, maybe even meet the tenants if that's possible, and then just doing a bit more of a sort of on-site due diligence at that point.
That makes sense.
Yeah.
And then when you start doing your pro forma, what are you typically looking for? Is it IRR? Is it cash on cash? How are you evaluating that from a financial perspective?
Yeah, absolutely. So it's for us, it's primarily internal rate of return, IRR. And really you have to evaluate it that when you're talking about, hold periods that for us are 5 years plus and most typically 10 years plus, you really got to consider that the time scale, right? And so for us, the IRR gives us a good metric in which to evaluate these properties and, sort of the ebbs and flows and what we're anticipating for lease renewals and mortgage rates. And we're just putting all of that into that pro forma, calculator, that machine that is going to give us that metric for IRR that we want. And that's going to allow us to properly evaluate the performance of this particular asset over a set period of time. And so that's definitely the metric that we use.
You mentioned you look at a lot of deals, so you've got a good pipeline of deals coming to you. In addition, I'm sure you're searching for deals as well. I know that that's what a lot of newer investors always struggle with, is how do they get that deal volume so they can look at more deals. And I mean, I'm sure you'd agree with this as well. Investors should be looking at everything and not just looking at one deal that comes across their desk and trying to make it work. They should be looking at everything and then trying to pick out the one they like best. But to do that, you need volume. You need deals coming. So how are you finding deals? How are you getting deals sent to you?
Yeah, that's a good question, Chad. So I think it's a combination of a few things. So one is, obviously there's deals that just come up on the MLS, right? So those are a source of deals for sure. But I would say the primary source for us is establishing relationships with brokers in all of the secondary markets that we're interested in, right? And that takes time. This is what I tell people: like you've got to go and have coffees and go for lunches and maybe the odd golf game here and there, and just go and establish these relationships and make sure that you're on the radar for those brokers that are active in the markets you want to be in, that are doing the types of deals that you want to do, that have sort of their finger on the pulse of what's happening. And so I think that's really important, is to have those broker relationships set up and, keep those lines of communication open, because even if you can get an advance notice of a deal that might be coming on online and listing, or even better, if it's an off-market deal, that might be something that is going to be a home run for you in the end, right? So just having those relationships set up, I think, is super important. So that takes time, but I would say that is definitely a very, very viable source of deal flow, is just having those broker relationships and getting your finger on the pulse of what's going on.
So if you were looking to enter into a new market in Ontario and it's one that you're unfamiliar with, you don't know anybody there, how do you do that outreach? How do you find a broker and try and start that relationship? Anything that's worked well, or anything that you'd avoid doing?
Yeah, good question. I think, so in secondary markets specifically, one of the things that I found is, just because of the size of some of these markets, a lot of brokers tend to do it all. They say, okay, well, we'll do residential deals, we'll do commercial deals. You want to do this, that, strip mall, whatever, because of the size of the market. Mm-hmm. So I think it's important to sort of source out brokers in those markets that tend to focus either exclusively or primarily on commercial real estate transactions, right? And I think dealing with a broker who really understands a commercial property versus a residential property and isn't just doing one-off deals here and there, I think is super important. So that takes a bit of just asking around. That takes a bit of just making some calls to the local brokerages or finding out on what they're doing online and things like that. I mean, now with social media and everything, a lot more people are sort of connected that way, so it's easy to get referrals. But I would say that's one of the things I found is really you want to be, even though it's a smaller market, you want to be finding brokers that are either primarily or exclusively working in commercial real estate.
Yeah, I think that's great advice.
Yeah.
When you're dealing with interest rates right now, to make a hard pivot here, that wasn't a seamless segue at all, but on interest rates, I think, and my crystal ball is so murky, I thought the Feds were setting us up for a cut or two in the U.S., and Canada always seems to do whatever the U.S. does anyways. So I was optimistic that we would see some cuts. Now I don't know, not only do I not know if there's going to be any cuts, I don't know if it stays flat, and I don't even know if we don't see an increase this year. I think everything is on the table this year, and if anybody has a crystal ball, I'd sure love to hear it. But with interest rates, at least as they are right now, seem to have been steady. We at least know that there's no cuts coming, there's no increases coming. It's probably steady for the foreseeable future. So we know at least what we're dealing with. It wasn't like 2023 when we're like, oh, we're getting a rate hike every meeting. At least it seems to have stabilized. Does that affect how you're looking at deals right now, or how do you navigate this crazy interest rate environment?
Yeah, well, I look at it in a couple ways. So primarily, you want to have confidence in the decisions that you're making. So when there's a market like this, you're really looking for any type of confidence or certainty in any one of the variables on a deal. But if we're talking about financing specifically, in an interest rate environment like we had last year, where rates were constantly going up, there was rates going up, and we knew that maybe we should lock in this particular lender right now because rates are going to go up, and this deal we've got to make work, but there's a great deal of uncertainty. Whereas I find there's more, even though the market is not ideal right now, there's a bit more certainty in the sense that we don't see rates going up much higher, if at all. And really, it's a question more so of when they're going to come down. So even though it's not ideal situation like it was 2-3 years ago, where interest rates were much lower and everybody's doing deals left, right, and center because of the cost of capital was so advantageous, I think there is some certainty, or at least a little bit of comfort knowing it's probably not going to get much worse than this. So the risk that you were maybe working with a year ago, that's come down a bit, and it allows you to have a bit more kind of confidence when you're underwriting these deals and sort of having your contingency set up if things do go a little bit sideways. So I think there's that. But the other thing that I'm seeing as well is, sellers, I think, are now coming around to the fact that, okay, we may be in this higher interest rate environment, and this price per square foot that I thought that I could get just because the market was hot 2-3 years ago and I thought it was going to still stay hot. I see some of those sellers come to the table and working with buyers and saying, okay, this isn't realistic anymore. And so that gap of the bid and the ask is narrowing a bit. So that's the other thing that I'm seeing.
Yeah, I think that delta between bid and ask is the highest I've seen it in 20 years this past year. And it's caused a lot of deals to just not come together because buyers understandably have different expectations because the cost of debt is higher, and sellers still wanted to get that 2022 pricing, which I understand that as well. So you're right. I think that there is a converging towards middle ground now where sellers are saying, okay, well, pricing has come off, and buyers are saying, well, if you want to get a deal, we still have to come up a little bit as well and maybe leave a little bit on the table. But you're right. I think that this year there should be more deal volume over last year, which was pretty slow from that investment of transaction velocity. I think it'll be a better year this year. What's your conviction or your belief on industrial, and if you're explaining it to someone, whether it's a family member or a friend, and they're like, why industrial of all things? Why don't you go and buy a shopping center or an apartment building? Because a lot of people just don't understand that industrial side. What's your message to someone on why you like industrial?
Well, there's a couple things. That's a good question, Chad. And believe me, I've had this conversation many, many times. I'm sure you have too. Right. But I think it's a couple things. One, again, going back to what I mentioned before, just the simplicity of it, right? And so that's one of the things I love. But I think we have a perfect example, honestly, from the pandemic, right? So if you look at those asset classes that did well through the pandemic, it was beds and sheds, right? It was a lot of the multifamily residential, just out of sheer demand that people needed places to live. Versus, a lot of the population growth and immigration that was happening. But also there was a huge demand for industrial real estate, because industrial real estate houses those essential services and those tenants that everybody needed throughout the pandemic and going forward. So it's, you and I both know, it's these types of tenants that are providing construction services, trade services. We have tenants that are restoration companies, and they work on power equipment, and all these different things that make our society run. And these aren't necessarily glamorous types of businesses, but industrial buildings house these essential services. These house these small businesses and all of these sort of trades that the economy needs to run. You get into the bigger industrial spaces, it's warehousing, it's distribution, it's all e-commerce, and that's driving that as well. So all of these things, the pandemic gave us this perfect kind of case study of why industrial is so important. And so, I think for me, I just point back to that whenever anyone asks, and I say, well, look at how well industrial did through the course of those 2 years and continues to do well. And I think that's a great example of why it's a great asset class to be in.
Yeah, love it. Couldn't agree more.
Yeah.
What are you using to stay on top of the market right now? Or is there things that you read regularly, or news, or how do you keep being an expert when a field that is always evolving?
Yeah, well, I think it's great now because, there's a lot of guys like you who are active on social media, who've got podcasts going, who are putting out content. So I think that's definitely a great way to stay up to date with things, is just, connect with those people who are providing value to the market, whether it's on LinkedIn or whether it's on YouTube or podcasts, et cetera. There's a lot of great information out there from, different brokerages and research companies. I know I follow reports from CBRE, from Altus Group, for example. They publish quarterly and yearly updates and forecasts and things like that. So I think that's another great source for people if they just want to get a broader perspective on what's going on. And then they've got some local sort of market reports as well that you can look at, sort of what's been sold recently, price per square foot averages, availability rates, and things like that. So especially if you're doing research on a market, or just want some sort of background information to justify maybe what you're seeing, specifically personally in terms of a market, then those are great things to look at as well.
Yeah, I'd echo that. And there a lot of those big brokerages or appraisal firms or investment banks, even they have an option. You can just sign up, put your email in, and they'll send you those quarterly reports. There's three other ones actually that come to mind that I recommend. Globe Street, globest.com, and BizNow, mostly US based, but a lot of overlap. I get sent stuff from them all the time, and I'm regularly reading their articles. And then in Canada, renx.ca is another great one. It's all specific Canadian content. So at any given day, I probably get 3 to 5 different reports or updates or something from one of all the different ones I'm subscribed to. And at some point, it becomes overwhelming. You've got to filter through it, but there's a lot of resources out there for people that look, but it takes work, and I think that's what a lot of people perhaps underestimate when they're getting into it, is that there's not an encyclopedia of here, go and read this book and you're going to be equipped to invest in industrial. Yeah. It's an active, ongoing process to stay on top of it.
Yeah. What I would also add though, Chad, is those reports, like I said, they're going to give you a little bit more of a macro perspective on things. But the other thing that you have to do as real estate investors is really just go out there and understand your local market too, because a lot of these reports are it's a very sort of broad brush approach to those, and they're collecting data points from again across a very large sort of base. So it's really important to get out there again. Talk to those brokers, talk to the people in the market, talk to businesses. The local chamber of commerce knows maybe there's a new business rolling into town. Maybe there's some funding for a particular project. So especially when you're working in these smaller markets, that's really important to do. So it's something that, I've been focused on just getting a really good understanding, even though you're not living in that particular market, making sure that you're making regular visits to that market, setting up business meetings, even with, members of city council if you have to, and just kind of getting a better understanding of what's going on in that particular market, just so you can use that to your advantage when you're making your investment decisions.
Those are great words of wisdom. How's your podcast going?
It is coming soon. Yeah. So we've got a few episodes in the hopper. And as you know, we were on the podcast a couple of weeks ago for your episode. And so, it's coming out soon. We're looking to have the final production and everything for the first 3 episodes ready to go by the end of April. So that's coming up soon. Yeah.
Yeah, that's exciting. Yeah, I'm glad that there's another voice getting into this, especially Canadian, because I know from people that I talk to, there is a big appetite for content, of just having the ability to learn things. So I'm glad that you're doing this. If I can ever help with anything, please let me know.
Awesome,
just closing off on that thought too. So I'll make sure to put your upcoming podcast in the show notes, and your LinkedIn and your website. If somebody is listening to this, they perhaps have a property they want to put in front of you, or it's a broker that wants to meet you and put properties in front of you, what's the best way for someone to get in touch with you?
Yeah, best way is through our website. So focuscapital.ca, focuscapital.ca. And on there, we've got all the information, contact details. There's a link to my LinkedIn profile. You can find out about our projects, different podcasts that I've done, and some info on the upcoming podcast, as you mentioned. So focuscapital.ca is the best way to do it.
Awesome. I'll put a little banner here, hopefully, with that, and then I'll also include it in the show notes. So thanks for sharing that, and thanks for jumping on the call. It's always great to chat with you.
Awesome. Thanks a lot, Chad.